Welcome to Real Talk, Real Estate Discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
Episode 77 of Real Talk. For about 2 years, lenders were very patient in not exercising remedies. They would enter into loan modifications or extend and pretend structures. And at the turn of the year, beginning of 2025, we noticed a significant shift in lender behavior, in being a lot more forceful in exercising remedies and being a lot more forceful in asset managing their loan documents and aggressively interpreting what would have been normally a non-recourse carve-out guarantee in trying to get recourse, whether it was through a typical bad boy carve-out guarantee or an interest and carry guarantee. And it really set shockwaves through the industry. And that's why I wanted to have on today's show Michael Cohen, who is a managing director of Brighton Capital Advisors. And Michael has decades of experience in working with lenders, particularly CMBS lenders, but other types of lenders, in negotiating restructurings, AB notes, and other types of creative outcomes between lenders and borrowers. And so I hope you enjoy my conversation with Michael Cohen. Hello, welcome to another edition of Real Talk. I'm here with my good friend Michael Cohen of Brighton Capital Advisors. Michael, how you doing today?
I'm doing great. Thanks for having me.
Absolutely. I assume, are you sitting in New York right now?
I am in New York. We're based in Charlotte, North Carolina. We're brought down there between 20 and 25 years to start CMBS programs at First Union and Bank of America and what's subsequently Wells Fargo. But we love it down there. I just happen to be in New York today because we've got a lot of stuff going on all over the country.
Oh, that's great. Well, this is like a spin-off of another podcast that you and I did with our good mutual friend and client, Bob Hart of True America. And I guess this is the sequel. But maybe it's the first one, in case people didn't see our first podcast. But for some, it's a sequel. For some, it's the first time. But definitely,
I think that was a good one. I think that's a good introduction for CMBS 101, or people trying to figure out, like, okay, these 4 letters, and I hear that it's a bad 4-letter word, and what should I know, and how did it become? And I think maybe today we can kind of jump into a little bit more tools that people can use.
For sure. We'll do a little 1.0, and then we'll do the advanced class as well. So just as a refresher for those that may not know you, although I feel like the entire world should know you, what does Brighton Capital Advisors do?
So Brighton Capital Advisors advises borrowers and represents borrowers and their counsel through CMBS servicing, master servicing, and special servicing to resolve default issues, loan maturity defaults, get extensions, modifications. But in CMBS, where there's no real relationship, there's a lot of administrative things where you filed the debt service coverage trigger, and that causes a trigger to sweep all your cash flow, or you're trying to get the loan assumed and nobody's paying attention. So what we really do is we sell access to for our borrowers, and we provide that service. And when a lawyer gets on the phone, the bank has to get their lawyer on the phone. So what we do is we kind of represent you guys and keep it on the business side.
Yeah, I mean, a lot of my clients, as you can imagine, over the last couple of years, have called me and wanted me to get involved right away. And I said, look, let's take a minute. I'm happy to help you. I'm happy to represent you, but you're calling me because your property is in trouble. It's underwater. The last thing you want to do is add more expense by adding the lender's counsel in this fray. So use me behind the scenes. So Michael, I guess I could say that you're the actor that's in front of the camera. I'm the director, producer behind the camera, staying behind the scenes. What is it that my client how can you best help them?
I like to start out by telling our clients what we do in each one of our backgrounds of our group, because it's really important. Because what we're gonna do is we're trying to figure out what the servicer is thinking about, and then mimic that so that we can actually come up with a game plan that works. Um, my background is I started in CMBS in 1991 and formed the conduits at First Union and then Collins Financial, which and then moved over to Deutsche Bank and then UBS and Citi. So as the head of the Southeast and the Mid Atlantic. So understanding the origination and understanding the borrower's head is really important. But I have two people on my group. One is a lawyer, ex-lawyer that was a senior internal lawyer in CMBS, and an internal closer at Bank of America, and then co-head of large loan special servicing and conduit special servicing at when it was B of A and Merrill Lynch. And then third, we have a woman that worked in CMBS special servicing at Wells Fargo for 20 years. Why is this important? Because when you're negotiating and trying to figure out the issue with your loan in CMBS, all these different constituents are in silos. So you have to understand what the rules and regulations are. You have to understand the legal implications to it, and you have to understand the business side of what's going on. So when we talk to our client and you'll say, the first thing we always ask is, okay, Andrew, what should the borrower be concerned about with personal recourse? Because that's really the number one threat to any borrower. And that's what these are non-recourse loans. We want to make sure that we're not going to expose them to any risk of that. Once you're able to tell us, okay, these are the risks and these are not the risks, we'll come up with a plan. And with CMBS, everything has to be in writing. We have a lot of borrowers that like to call up the servicer and speak to them directly and think that they've made a connection and a buddy, but it doesn't work that way because there's a number of constituents. So what we do is we come up with a plan approved by the borrower, approved by the attorney, and incorporates all the needs that they need, the borrower and the attorney need, to get done within the modification or extension.
Yeah, you hit the nail right on the head. The most important question is the guarantee, right? So, and that's not always an easy question to answer because more and more over the last few years, even if you think you have a non-recourse carve-out guarantee that only triggers a guarantee for bad boy acts of fraud, intentional misrepresentation, et cetera, bankruptcy, et cetera, we've seen a growing, a creeping of recourse, even when a borrower may not have expected.
I will say that the servicing, the way that the actions of the servicer and especially the special servicer has been really since post announcement of tariffs is very aggressive.
Yep.
We've seen a number of cases where they're looking backwards and saying, you know what, we will modify this, but we should have really put that lockbox in 3 years ago. So we need you to write a check for all the monies that you should have been giving us, and then we'll talk to you. And I've seen this not only on a modification, I've seen this on a loan assumption where they're saying, well, we will not approve the assumption of your loan until you give us this extra collateral. There is a very aggressive nature to this. And we find that borrowers who are trying to do this without counsel, without us, are really running into a wall because they have no power.
So when should they call you?
Borrowers should really call us when they know that there's a situation coming ahead. It's really 6 to 9 months ahead. And you might say, well, that's a long time. The issue is there's only the special service, the master and special servicing process is not very efficient. It's not built to be a volume of changes because these loans were never meant to be changed. Two, since the tariff announcements, their volumes have probably tripled. And you can watch that not only by the comments. We talk to all the major master and special servicers because we've got deals in around the country with them all. But they'll tell us that. But also you can look at the data and the TREP, and it will show you how many loans are getting transferred to special servicing. The default rates are at an all-time high right now, higher than they were during COVID.
How about compared to GFC?
GFC, there was a difference. I want to say that there's just as many defaults or more. GFC, people were running out of money, and there was a liquidity problem. This time, there's not a liquidity problem. In fact, the banks are well capitalized. The problem is you can't find a loan out there today.
Yeah, absolutely. So, a client will say, so Andrew, how can you help me? What have you seen with particular lenders? What's secret sauce do you know? And I'll be transparent. I'll say, guys, I can't pull a rabbit out of my hat, right? And just because a lender did something for a particular borrower does not mean they're going to do that same thing for you. Everything
Correct.
is so specific about the relationship. How extensive is the borrowing relationship across other properties? Who is the lender? Who is the servicer? How is the asset doing? Where is it located? What type of asset? I mean, you could go on and on and on. But are you seeing some trends of commonality of an outline or a playbook that you can tell a borrower?
We're starting to see, as I said, we're starting to see trends both negative and positive. We're starting to see trends of aggression, of the servicers not accepting a proposal if it's too offensive. We're looking at a very, very large $200+ million deal in LA right now, where the ask from the borrower was so aggressive and wanted so much that the special servicer basically shut them down, didn't even respond, and didn't put a receiver in. Because you have to be thoughtful of and understand the entire process of what's going on. This is a situation where there's a lot of professional companies who are going to make a lot of money on this deal, and this is not a relationship. I think that the borrowers have to be concerned about communication and how and when they communicate. That we go to a lot of servicer conferences where we're the only advisor let in. They like us, and we talk to them, and we hear them all saying the same thing. Why are the borrowers coming to us so late? Why did the borrowers not giving us full information? So I always say, be prepared, be proactive. What does that mean? That means put together the plan, show the lender that you're the best to shepherd this loan through, that you have a plan, you have money, and instead of doing a loan pay down, let's keep that money at the property level to make it accretive. So you're showing that the servicers, there's different temperaments to different servicers, and some people say, well, you're talking to a special servicer A, and I hear they're really hard and they're just impossible. We got a discounted payoff from an office property in Chicago from special servicer A. Why? Because we went in with a thoughtful plan. We showed them exactly what was happening in the market. We showed them the broker opinions of value. We showed them the alternatives, and we did their job. We've done their job for the last 25 years, so we understand it. But it's a matter of really communicating. Everything has to be in writing because it goes to a number of different parties. With the decision-making parties are not within one office. They're within 3 separate groups. You have a master servicer, a special servicer, and sometimes a controlling class holder is the lowest rated bondholder at the time. So that means that you have to communicate this effectively and really speak to all the different constituents.
So I often am talking to clients who are attempting to do whatever they can to save the property. They're putting money in each month to satisfy any shortfall, right, that the property would normally have had, where the loan would not be being paid current each month, but for additional capital. And they will be doing that for 6-12 months. And we're not at a maturity default yet. And there's no payment default because the client has been feeding it for a good while. And they throw up their hands and they say, you know what, Andrew, I just can't do it anymore. But I feel like the lenders are not giving them credit for the 6, 12, 18 months of feeding this thing. And they asked me, Andrew, should I just go into default? I've never been in default before. I'm scared to go in default. What is that going to do to my credit and my future lending ability? What do you say to a client where you almost need to tell them, in order to get the lender's attention, there needs to be a default, because right now they just perceive you as a performing loan?
That's old school. That's CMBS 1.0, where you try to get the attention. We highly recommend that the borrower keep paying. However, they come to you earlier in this, that they can recognize where we're going. Look, nobody wants to keep putting good money after bad. But that bad, if the property has a potential and you really believe in that property, then let's express it to the lender. They're going to work with you at that point. When you stop paying, and we have this question all the time, should we stop paying? If you stop paying, we start to run out of options on how to negotiate with the special servicer. Because first of all, when you get transferred from master servicer, who is the administrator, to the special servicer, who is more of a decision maker within the loan documents on making modifications to the loan, you immediately start to incur fees. Immediately. And that clock starts ticking. And also, if you're in a major default, for example, maturity default, you'll start to get notices of default, of foreclosure, and now you're kind of having to deal with the servicer who's going to give you the options versus us being able to set the table up. So what I would say to somebody is, if you're 3 or 4 months into this, you do not see a new tenant coming in so soon, or you need to, or maybe we have scenarios where we have one borrower and 75% of his partners don't want to contribute anymore. So we're saying, okay, well, hey, bank, do you want us to, our guys will continue, but we'll put in fresh equity too, but we need a loan restructure here. And it's working, because I think with the stabilization, I think we're all in an agreement that interest rates are pretty much going to be a bit higher for a while. And if that's the case, then we understand where cap rates are, because they can't be lower than the interest rates. So that's one of the reasons why you're seeing the banks get so aggressive, because now they know they have a market. So what you want to do, we have 2 types of borrowers. We have borrowers that come in and say, hey, look, I need help because I'm getting fatigued here. I can't keep funding this. This doesn't make sense. And by the way, if you're funding it now and you're 18 or 24 months into it, where are you going to be in another 4 years? You're just going to keep dumping money and you're going to have a balloon risk. We also have borrowers that say, hey, look, I have equity in my property. I happen to lose a tenant just now, and my maturity date's coming up, and I'm fearful that one of these servicers, these special servicers, is going to come really aggressive and not negotiate with me on an extension and just foreclose on me. So we call it, that's a bit of an insurance policy. They put us on retainer for an insurance policy, because before you get to that event, we want to start having dialogue and memorialize what we're talking about with the servicers. And I'll give you an example. We had it's on our website. You can look at Marriott Grand Cayman. It was coming due in July of it's a couple of years ago. 6 months before, they came to us and said, look, with the island shut down, we couldn't do it. And we created a plan. And the plan was to ask for a 3-year extension. Well, by the time we submitted, which is probably 3 months prior to the loan maturity, and had dialogue and socialized between the master who was socializing with the special and the controlling class holder, By the time we got to the maturity date, we went right into a forbearance agreement because they understood it. So what did that do? That avoided any nasty negotiations when you got into special servicing. That limited the time in special servicing for special servicing fees. So you can't think this is not the same as the last recession. There's no money grab there. In fact, you have to be very concerned that the special servicers are going to collect a lot more fees, and they're fee hungry right now, and you cannot sue them.
Yeah, no, absolutely. And I agree with you that over the last, really since the turn of the year, the lenders have become across the board increasingly more aggressive. Yet I am also seeing some lenders who are aggressive, but yet they aren't taking the final action of either a foreclosure or accepting a deed in lieu. It's like they don't want the asset. And I'm curious of your thought as to there have been clients of mine who are essentially begging the lender, take the property over. I'm willing to do a deed in lieu. And the lender says, you can't force us to take the property. You have to keep the property. Why?
Well,
why is the lender?
That's interesting. That I've seen that a lot happen on the balance sheet side, and that's the game of chicken of, okay, borrower, if you don't want to put more money in and there's waste or loss, we're going to come after you. We're looking for you to trip up your personal recourse carve-outs.
Exactly.
I will say that the kicking the can, you can extend for as long as you want, but you can't pretend that there's no more money left at the property. And that's where the real issue comes in. And I think right now we're going to start to see lenders, who were maybe not foreclosing before taking action. I think that I think they see a stable enough market to go out there and get a frothy bid. I think to your point, you need to go out to the market, and first, before you need to know everything. You need to go out to the market and see what your value of your property. Can you sell it? What can you do? You need to talk to a strong broker and cover the market and see what kind of terms out there. If you're looking to hide and get an extension because you don't like the new rates out there because they're at 7 and you're at 3, I can't help you. But if you're out there because you can't get a loan and it's undervalued, but you think that with some TLC and some money and a good business plan, you can get there to the next level, you're going to get an extension. At the end of the day, the special servicers, they want you to succeed, to pay off your loan. I mean, that's the whole. Bondholders are very happy. Now, the special servicers are also money hungry, and they have a kind of an unfair advantage over you. In the event that you start to not pay, or they'll take their time because, one, they're collecting servicing fees. 2, if they have to make advances for you, they're getting interest on that. But the whole thing is that all the fees that they're due, if they took your property back and they liquidated it, they get those monies first. So they don't have an incentive. You can't threaten them. They're money good at all points. You just have to put in there that a servicing standard of, look, and if you have to show to a judge, look, I did everything I was supposed to do. I showed them the property and they became too aggressive.
Yeah.
So,
but do you find, because special servicers are almost incentivized to just continue this elongated process of staying in special servicing, it's almost a pervasive incentive not to have final resolution?
There's a pooling and servicing agreement that was written when the servicing rights to the bond were sold. That wasn't privy to the borrower when they closed the loan. The borrower didn't know who the special servicer was going to be in most cases, and they didn't know what the special servicing agreement says, or the pooling and servicing agreement. We know what that says, so we know that there's a finite period of time that they can leave it in there. And in fact, they also get rated by the rating agencies as to why. There are watchdogs to kind of prevent them from just milking these properties for forever. So again, if you have a plan and we put everything in there in writing and it gets socialized, it's kind of hard for them to justify to keep it there as long. Where you get long is when somebody says, okay, I'll do this myself. sends in a handful of documents. It's a 1 or 3 page letter. It doesn't incorporate everything they need. It takes 3 weeks, and then they turn around and say, well, that wasn't, we need this and this and this. And now you've already lost their attention. So we know that Brighton Capital, we go through the process, and the key to our success is the servicer, the special know that we have informed the borrower and their counsel exactly what the parameters and what's going and happening in the market today. And we're able to provide a full package, a comprehensive package. So there's a deal in there. We're gonna be pro borrower, and we're gonna ask for the most. But it's easier to negotiate things off the table than it is to put things on the table, and that's when you get the special servicing.
All right, in our final moments, obviously there's been a lot of note sales that we've been transacting on. Is it a firm rule that a CMBS lender will not sell their paper to the borrower?
No. There's discounted payoffs that happen. We've been part of it. When you are doing a discounted payout, and we're also working on AB note structures where there's a potential for the borrower to make a future. I will say this: if you go out and you buy if you're able to get a discounted payoff, there's one is the strategy, which is you have to give best and final number from day one. That's it. You have to be ready to walk. And if you're ready to walk, you're ready to walk. But give the number. You're not going to be able to horse trade. This is because they're going to say no, and then you're going to be chasing a windmill. So you have to go in with your best and final on day one. The second thing is there are look backs. If they give you a discounted payoff and you think you're going to sell your property in 2 years for a lot more money, they're going to put in look backs into that. So be prepared by having really good counsel and having really good advisors to kind of tell you what we're seeing. Because you mentioned this before, are there trends? Yes, there's trends, but nothing is programmatic, which is actually can be beneficial for a borrower, because we can actually modify and custom craft loan resolutions to be optimal outcomes for the borrower, because there is nothing programmatic. When it becomes programmatic, you get what you get. And we're not there yet, but I think certain things we're going to become a little bit more programmatic, but there's not going to be a wholesale changes because it's not to the benefit of the servicer.
Now, we are seeing loan sales, as I mentioned, but they've really been on single asset transactions, yep. One note at a time.
Yep.
And I've talked about this in prior podcasts, when I was working as a lawyer, I still am a lawyer, but when in the days of 2009 through 2013, my days were filled with tapes of loan sale transactions, mm-hmm. where you would sell a portfolio of loans, and a client mm-hmm. would have maybe 3 days of due diligence to underwrite the portfolio and then close quickly thereafter, mm-hmm. On large portfolios. I haven't seen any of that.
Correct.
Why the difference? So
in the past, we were dealing with a liquidity crisis, and now we're not. So I think you have to kind of look at the government regulators in this, where they don't want panic. I mean, that's going to be an issue right now. If you're buying a loan, you don't know whether if the banks were start to dump loans into the marketplace without a governor on it, we would see a lot of valuation decline even more rapidly. So I think what they're trying to do is slowly kind of let this leak out. Now, why are they doing it one by one? So right now, we're seeing some loans through CMBS. Everybody asks me, well, can I buy that loan from CMBS? How do you get in there? Well, it's kind of complicated. You can get to the controlling class holder, but it's usually what we're seeing is these loans on a one-by-one basis are going to large family offices, or they're going to a large investor who will come out and they'll place the loan. And that's probably up to about $75 million. the rest of it, because of lender responsibility, they have to put this on an auction platform. So we're either seeing poor loans that are getting bid up higher than they should, or or loans that are getting bid up closer to par. I always tell the investors, if you want to invest in CMBS and you want to buy a loan, the best way to do it is to find the current borrower who, and we could find this through TREP, we can help you find this, and talk to that borrower to see if you can come in as preferred equity, if you can come in as something that will help that borrower. There's a lot of borrowers that can't give the keys back right now because they'll have a tax issue. So if we come in and you come in as a new equity and we can modify the loan and you can keep that borrower in for a certain amount of equity, which doesn't trigger their tax consequences, that's the way to do it, because otherwise you're going to just sit in the rest of the market and wait for the auction platforms to come out, and you're going to bid with everybody else.
I guess last couple questions. I know I said that a couple questions ago, but
Okay.
The conversation keeps bringing up more questions. You mentioned a couple of times an A-B structure.
Yes.
For my audience that may be unfamiliar with how to utilize an A-B note or an A-B structure as a way to solve their issues or maybe kick the can down the road, can you please provide more clarity?
We're working on 2 towers in downtown Chicago right now. They're 2 million square feet, and I'm going to make up some numbers. The loan amounts with 300 million. The value of the properties is 75 million. So, and the borrower is willing to come in with 100 million to put more.
100 million of new equity.
New equity, correct. Right, and I'm using very large numbers. We can scale this down. We could be I'm working on a loan in another suburban of a major city, and it's a $50 million loan, and
That's use your numbers.
So what happens is if I'm going to bring in $100 million more on a $300 million loan, that will never achieve a $300 million loan value. I'm not gonna do this. I'm not gonna bring in I can't get new equity to come in and then pay you off. So what you do is you create an A-B note structure, and the A note really is sizing to today's dollar, today's value. So let's even make it easier. So let's say that the value of the building is $100 million and it's $300 million. So what you do is you say, okay, the new A note is 100 million. And then if I put another 100 million, I think I can get the value. I can get a value that's going to exceed it, where I can get I could pay you back 200 million at the end of the day. And so what you do is you create an A-B note structure. Some of it is discounted from the top of the 300. And then you say the new note and the terms are at the 100 million. That's how much I owe you today. That's the A note. That's the note in place. And the waterfall says we're going to pay you back on the A note. Then we're going to pay the preferred equity, all their return on the new equity. And then anything left after our sale, we're going to pay back towards the B note. The B note is often called the hope note because it's a split between the borrower and the lender. So what it effectively does is it pays any new equity comes in. You have to pay back new equity, and you can't have a loan that's too high.
Correct. And I feel, though, that a lot of the lenders, when you propose the A-B note structure, they just seem unwilling to chop up their note and have any part of it subordinate.
Correct. And the reason is because you're asking them to take a loss immediately. And so understandably, they're like unwilling. They're like, wait, what? Nobody rushes to take a loss. So they say, no, I don't want to do that now. But in certain instances where you have two buildings that are crossed, but one of the buildings is obsolete, it's an R&D building, and you can't lease it again, or you'll never get there in value, well, then, hey, lender, here's your choice. We'll give you back the keys, and you can have this thing that's worth a third of the loan amount, or we'll put more money in, and we're the best shepherds to take you through this. So again, very rare. These are rare. It happened more in CMBS 1.0 because they needed the money and they needed to make a decision quickly. In this case, we have a case that they went in and they asked for something like that, and the lender just went on deaf ear. I mean, now after another year or 2 years of the loans sitting there in special servicing, but the market's getting better, they don't need the AB note structure anymore. So time is curing. If you go back, somebody made a great point. In CMBS 1.0 in 2012, when everything was kind of at the bottom, it took us until 2015 to really start to transact. That's when I got back into CMBS in 2013 and 14. Those were rocky years. In 15, things started to take off. And in fact, one of the things that everybody should note is that at the fourth quarter of this year, we have $150 billion of CMBS loans coming due. 80% of those loans have coupons of 5% or less and debt services coverages of 150 or less. So what does that mean? Every single one of these is going to be a cash in refi. So and don't think you're the only one defaulting, and don't think you have any. You gain no power by waiting to get into special servicing and then trying to go hand-on-hand combat. It's the worst. You put yourself in the worst position. Actually, only second to worst to the people who stick their heads in the sand and think something's going to get better.
Yeah,
because you're going to get the default notice.
They were hoping rates would come down, and they never did. And so everybody said, stay alive till 25. We're now in the halfway through the third quarter of 25. What's the phrase of getting to 26? Because it seems like there's going to be more distress in 26.
Correct. I guess it's our culture to think in 12-month increments.
Yeah.
And we think that, okay, well, it will get better because in the fourth quarter it's going to get better, or after the summer. I'm actually predicting, and this is just by being in this business for 30 years, is that in about 2 weeks we're going to start to see some movement, and it's not going to be good, and people are going to come back and they're going to say, you know what, I'm first out, and these lenders are going to start to take action. I think borrowers are going to start to feel the crunch. I mean, there's plenty of equity out there, but it's not cheap. And honestly, there's not a lot of homes, and it doesn't matter. It's not just office. So you can have we're working on an apartment building that it's in a downtown location and which has crime and homelessness and is having difficulty, and it's never going to make it. We have hotels. We have retail centers that lost a tenant up in Northern California, and they need time. And when you're working with CMBS special services, like dealing with a pawn shop, you have no relationship, and you have to understand all of the rules and regulations, or else you will get burned.
Yeah. Well, look, Michael, I'm so glad that you were able to come on to my show. You are a wealth of knowledge for my listeners, for my clients, and I know that you will be able to help them. So long as they call you early. My clients don't call Michael too late. You got to call him early. And so, Michael,
thank you. I'm gonna look. Our firm is nationwide. We have been out to your LA we're coming back out. We'll be out there. We're very accessible. We're very small, so we're going to take on our clients that we choose. But coming through advisors such as yourself, that's what we're really looking for. We're looking for, because when you're coming through, you and I were on the last podcast, and it was a very symbiotic relationship because of the understanding of what we're dealing with. And when you have that, there's such synergies, Andrew, that I really feel like you're the fourth component of when we're talking to the borrower and he's listening to you and he's listening to my perspective from being on the business side, and Richard's from being on the legal side, and Tina's from being on the special servicing side, that we can really kind of flesh it out and then make really the best decision on how to go and approach the servicer to get the optimal outcome. So, you know, you worked hard for this property, you want to save it, you want to do it, but you know, you can only do it under the right loan structure.
I completely agree. Well, look, Michael, thanks again for coming on. Thanks again for sharing all of your valuable information and your years of experience on CMBS, and best of luck to you in the future.
Yeah. Thank you. Keep an eye out for us. We post a lot on LinkedIn under Brighton Capital Advisors LinkedIn site. So we're at www.brightoncapitaladvisors.com if you want to see more of our insights or more of our case studies, because we post those a lot as well.
Fantastic. All right, Michael. Have a
Thanks
good day.
so much.
New York.
All
Take
right.
care.
Bye bye.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing this show with others.